Bank of America is currently trading at 52.19 USD, showing a sharp intraday drop of 2.18 points or 4.01% as of this moment on January 14, 2026. This sudden move downward comes exactly when many investors were looking for a victory lap following the release of the fourth quarter 2025 earnings. Here is the part that most people are missing. The bank actually beat expectations on both the top and bottom lines. They reported an earnings per share of 0.98 USD against the consensus of 0.96 USD, and revenue came in at 28.4 billion USD, well above the 27.55 billion USD that analysts were projecting. So why is the stock bleeding out in the middle of a trading session? The answer lies in the friction between what the market already priced in and the reality of where the profit is coming from. While the headlines scream about a beat, the underlying mechanics show a heavy reliance on volatile trading desks rather than the steady, predictable interest income that long-term holders crave. The expectation was that Bank of America would benefit from a stabilizing interest rate environment where their massive deposit base would finally stop being a liability in a rising rate world and start being a gold mine. Instead, the reality is that the net interest income is fighting a battle against the Federal Reserve that is now looking at potential cuts in June and July of 2026. When you look at the screen on your Robinhood app or check your individual brokerage account, seeing a 4% red candle on a day of good news is the ultimate curiosity loop. It forces us to ask if the fortress balance sheet narrative is starting to crack under the weight of a shifting macro landscape. We have seen similar movements recently with high-flying names like Nvidia stock or even the volatility in Tesla stock, where the numbers are great, but the forward-looking sentiment is shifting toward caution. If you are using tools like Schwab Intelligent Portfolios or managing your own online investment strategy, you know that the banking sector often acts as the canary in the coal mine for the rest of the S&P 500. Today, that canary is singing a somewhat dissonant tune. The 23% jump in equity trading revenue is impressive, but it suggests that the bank is making its gains from market chaos rather than from the organic growth of the American consumer. This is a significant distinction. When institutional clients scramble to reposition their portfolios on platforms like Interactive Brokers or through Fidelity Wealth Management Services, Bank of America wins on the fees. But for the average person looking at self-investing, the fact that net interest income growth is projected at only 5 to 7% for the coming year feels like a bit of a letdown. The tension here is palpable. On one hand, you have a bank that grew net income by 12% year over year to 7.6 billion USD. On the other hand, investors are looking at the efficiency ratio of 61.1% and wondering if there is much more room for improvement. When you open your Fidelity mobile app to check your Fidelity IRAs or look at your Robinhood investments, you have to decide if this dip is a structural warning or a classic overreaction. Historically, when the market punishes a beat, it is because the quality of the earnings is being questioned. In this case, the market is looking at the 10% surge in trading revenue and seeing a one-time windfall from volatility rather than a sustainable trend. This is the exact opposite of what we see with a company like Apple stock, where the services revenue is seen as a high-quality, recurring stream that justifies a premium valuation. For those who use online investing sites to track institutional activity, the volume today is telling a story of heavy hands exiting positions. We are seeing over 30 million shares traded already, which is a massive spike compared to the typical daily average. It seems that the big players on the Interactive Brokers trading platform are taking profits, or perhaps shifting their capital into other areas. Maybe they are moving toward the tech sector, or looking for investment help in more defensive postures. If you are active in the market, comment below how many shares of Bank of America you currently hold, or if you are planning to buy this dip. It would be interesting to see if the retail sentiment on the Robinhood app matches the institutional sell-off we are seeing on the professional screens. To understand why we are here, we have to look at the recent daily swings. The bank has been trading in a 52-week range between 33.07 and 57.55 USD. We were very close to that high until this morning. The macro pressure of the One Big Beautiful Bill Act and the expectations for 2026 U.S. GDP growth of 2.4% have kept the bulls hopeful. But the reality of the 2025 earnings shows that the consumer is resilient, but they are also becoming more expensive to maintain. Small business owners are reporting labor shortages and inflation impacts, which eventually flows back to the bank in the form of higher credit costs. Bank of America reported a net charge-off rate of 0.4%, which is actually better than the 0.5% expected, but the fear is that this is the bottom of the cycle and the only way is up. If we step back from the intraday noise, let's look at what this company actually does to generate these billions. Bank of America is the second largest banking institution in the United States. It operates through four primary segments: consumer banking, global wealth and investment management, global banking, and global markets. The consumer banking side is the heart of the operation, serving roughly 69 million consumers and small business clients. This is where your everyday interaction happens, whether you are using the Fidelity brokerage for your stocks or the bank's own app for your checking account. The global wealth segment, which includes Merrill, is a massive engine for fee-based income, managing trillions in client assets. When you think about online investment or getting investment help, Merrill is often the name that comes to mind for the high net worth crowd. Their business model has shifted significantly since the 2008 financial crisis. They moved away from high-risk lending and towards what CEO Brian Moynihan calls responsible growth. This means growing without taking on outsized risks that could jeopardize the fortress balance sheet. In 2025, this strategy worked well, as the bank benefited from a higher-for-longer interest rate environment that padded their margins. However, the older reports from late 2024 and early 2025 showed signs of slowing deposit growth as customers moved their cash to higher-yielding alternatives like Fidelity mutual funds or SoFi active investing accounts. This forced the bank to raise the rates they pay on deposits, which is now starting to bite into their profitability. The reality of the current situation is that Bank of America is a massive tanker in a sea that is starting to get choppy. While they have the scale to handle it, the agility of smaller fintech players, or even the aggressive moves of firms like SoFi and Robinhood, are creating a more competitive environment for those valuable consumer deposits. The SoFi Robo-Advisor and the Robinhood cash management features are drawing in younger investors who might have traditionally started their financial lives with a big bank. Even Fidelity ETFs and the wide range of Fidelity investments are becoming more accessible to the average person, reducing the stickiness of the traditional bank relationship. Looking toward the final section of 2026 and beyond, the future outlook for BAC is a mix of high-stakes catalysts and lingering risks. The primary catalyst for 2026 is the expected CapEx boom driven by artificial intelligence and energy transition. Bank of America's global banking and global market segments are perfectly positioned to facilitate the massive loans and equity raises needed for this transition. If we move from a consumption-driven bull market to one driven by capital expenditures, the investment banking fees, which were somewhat stagnant this quarter, rising only 1%, could see a massive resurgence. This would be the reality exceeds expectations moment that could send the stock back toward that 60 USD target many analysts have set. However, the risks are equally significant. If the Federal Reserve cuts rates too quickly to combat a slowing economy, the bank's net interest margin will shrink faster than they can cut expenses. There is also the political risk. With trade deals and tariffs being a major topic for 2026, any disruption in global trade will hit the global banking segment hard. Furthermore, the security supercycle and the shift in energy policy could create winners and losers for their corporate clients, leading to unpredictable credit losses. If you are using a SoFi trading platform or interactive brokers' fees are a concern for you, you are likely looking for the most efficient way to navigate this volatility. The expectation versus reality framing here is that the market expected a clean, simple growth story based on a strong economy. The reality is a complex, multi-layered financial report that shows a bank relying on its traders to cover up the headwinds in its lending business. This is why the stock is down 4% today despite the beat. The market is effectively saying, show us the sustainable growth, not just the volatility gains. For those holding for the long term, the dividend yield of 2.14% and the continued share buybacks, which returned $30 billion to shareholders last year, provide a solid floor. But for the short-term trader on the Robinhood app or the SoFi Invest platform, today is a lesson in the dangers of following the headline without reading the fine print. The central insights from today's session are clear. Bank of America is performing well on a fundamental level, but the quality of that performance is being tested by a changing interest rate environment. Expectations of a straightforward profit expansion have met the reality of rising deposit costs and a reliance